We have essentially tried to figure out how much this budget has raised. So every announcement comes with a forecast of how much tax will be raised by it. And by our maths, she's raised around 24 billion by undertaking most of the main measures. We've listed them out there. But I think the interesting point to note is that there are all these rumours about potentially CGT rates changing, income tax rate going up at basic rates, and all these other sort of potential changes that were mooted. But in the end, the thing that raises the most money is doing nothing. By not raising thresholds for income tax, for national insurance, for IHT, for the CGT annual allowances, she's raising far more money than any other measure which attempted to raise rates. So that's why the announcement that the thresholds are going to be frozen is actually her biggest single measure for raising taxes, even though effectively it's a do nothing. So whilst the headlines may say income tax rates didn't go up, the income tax take will in fact go up and be the biggest earner for the government over the next 3 years of all the announcements made. Although we say the income tax rates didn't go up, of course, we've already heard from Adam saying that the dividend rates and the rates on property income have in fact gone up. So whilst I was reading on the BBC yesterday that the income tax rate increases that were feared never materialised, I beg to differ. We did get income tax rate increases. They may not have heard touched upon the working person, as the government like to talk about, but I would counter that saying how many people who actually earn the dividends, certainly in our client base, people who are taking dividends are working awfully hard in their businesses, and they just happen to take dividends rather than salaries. But going forward, as part of this sort of ongoing planning that we need to look at, is some of the things we need to look at is the remuneration strategy. So it will depend on your personal circumstances, but with the changes in dividend rates, the question will be, should you continue to take small salaries, big dividends? Should you take more dividends, more salary? And it will really come down to the personal situation that you find yourself in, how much you have to take out, and what rate you're currently paying at based on your other income as well. So there will be some planning to do around the changes in dividend rates. Adam's already alluded to sort of the change in the property income tax rates, that potentially the idea of incorporation of a property portfolio may be attractive to more people as the income tax rates have gone up on property income. So if you have a significant portfolio of properties, then it may be worth having a conversation to consider whether incorporation of that portfolio is going to be beneficial. If you just have a handful, maybe 1, 2, 3 properties, you're unlikely to qualify for incorporation relief. So unfortunately, you probably have to suffer the tax. But if you were looking to acquire any new properties, the question would be, should we acquire that through a company or through personal names? So, yeah, it was an interesting budget in terms of what didn't happen. So there was no CGT increases, no IHT increases, no pension changes in terms of the overall amounts you can put in. Yes, there was the salary sacrifice change, but the overall annual allowances weren't changed. So it was interesting to see how much didn't actually change, considering how much was leaked beforehand. And with the emphasis being on the working person that they keep referring to, it was interesting to see the cap on IHT for non-resident trusts that they snuck in at 5 million that Adam talked about earlier. Essentially, that means the people that benefit from that cap are people who have offshore trusts that have a value in excess of £83 million. So I've struggled to see how they would be the working person that they like to talk about and benefit. But so be it. If that's who they would like to assist, that's fine by them. It's their decision. So there were some positives coming out of this. It wasn't all doom and gloom. Kelly's already mentioned sort of the VAT opportunity for UK branches of overseas head offices. There were also the changes that Adam and Anand spoke about for the EMI share schemes that were widened. So previously they were sort of for businesses with assets less than 30 million, that's gone up to 120 million. So therefore a lot more companies could qualify for EMI. And that's an interesting way to incentivize key employees in sort of larger businesses than could have offered that before. And again, with the EIS, the expansion of the type of company that can qualify for that, it'd be interesting to see if that does indeed improve the amount of investment being undertaken. Yeah, so I think we've already covered sort of the EOT. I haven't covered most of that stuff off, but it does, as Adam said, still have an interesting point about an exit strategy, whether you look to effectively pay 12% by going into an EOT, or whether you look to try and maximise your business asset exposure relief, which at the moment is 14% rather than going up to 18%. So it depends on your exit strategy, but overall, that was certainly an increase in the amount of tax, and they're expecting to raise around £1 billion a year from that change. So other interesting points that were around the minimum wage. So whilst the main rate only went up in line with inflation for workers aged 21 or over, the people below that were rewarded with a much higher increase, because the idea of this government, the plan for the government, is to merge the rates so that everyone over 18 will get paid the same rate. So we should expect to see higher increases for the 18 to 20 bracket year on year until the rates start to merge. They seem to still want to keep the 16 to 17-year-old apprentices at a slightly lower rate, but for 18 and over, it looks like they're trying to merge the rates together. So that was the